Hello and welcome. Moss Adams is pleased that you joined us for today's session, Energy Leases, Power, Utilities, and Renewable Energy. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1.5 CPE credits. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 75 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our Group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only one sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I would like to introduce today's presenters from Moss Adams. Julie Desimone, Partner, and Brad Ulrich, Senior Manager. Their bios and contact information are located in your webcast console if you would like more information. And now I would like to turn the floor over to Julie to get the presentation started.
Hi there. Welcome to today's presentation. Once again, my name is Julie Desimone. I've been working in public accounting in the power, utilities, and renewable energy space for the last 23 years. And I have to be honest with you all. We have been talking about the new leasing standard for the vast majority of this 23 years. So I guess the good news / bad news is it's finally here. It's been interesting because this one has been so long anticipated and taken so long to get to the end game that we've been talking to it a lot in very high form and had much more in-depth understanding in a very high level. However, now we're into the practical implementation stage, and that practical implementation stage has created a remarkable amount of nuances with the standard. So today's presentation, we're going to try to dive a little bit deeper with some case studies, some examples, and we're going to get into what us accountants love most, the debits and the credits behind the new lease standard. So I want to say a huge hello and thank you to Brad for presenting with me. And this starts, if any of you on the slide or on the presentation know me, you'll know that I like to start most of my webcasts and presentations with a story. So I was on the phone yesterday. I have a 19-year-old boy. He is a sophomore at Gonzaga University. And I was telling him how great it was and how nervous. My first presenter, the co-presenter with this, unfortunately was sick. Wasn't able to make it, so Brad stepped in, yesterday afternoon. So Brad, huge thank you to you. But I called Brad yesterday. I was like, he's my goose. And my son, like I was on a video call with my son, he just looks at me and goes, why do you need an animal on your stove? What are you talking about, Mom? Goose. And I'm like, my wingman, Keaton, my wingman. And he goes, what does a wingman and goose have in common? And I realized right then and there that we, one, weren't living in the same world because how could I have a kid that's never watched Top Gun? But two, that we were having a conversation where we were not presented with the same set of facts so that we had a common understanding about how the conversation was going. That, I believe, is one of the biggest pitfalls that we could anticipate with this new leasing standard. Many of us are accountants sitting in the room today, and we'll be responsible for getting to those debits and credits of the lease accounting standard. However, much of the information that we need to do the right thing is not going to be handled within our department. That could be an external department. And I can tell you, with the information you have available, you can do everything right, but if you're missing key points of information, then you're still going to get it wrong. So throughout this presentation, maybe be thinking about who do I need to get this information from, and do I have the right channels of information flowing as we continue to implement this lease accounting standard. So we highly encourage everybody. Brad is going to be watching the Q&A. We're going to save time towards the end. So please let your questions come through. Good one, Richard. We're going to have all the questions come through. We may not answer all your questions in today's presentation, especially if they're specific, but get them in there because we will follow up with everybody to make sure that your question was at least attended to, if not, hopefully completely answered by the end of the day. So get your questions in there, and we'll set some time aside for the end. All right, let's get into the agenda. I guess I have to realize I flip the slide deck. So here's what we want to talk about today. So we're going to get a quick summary of 842 because we always have to set the stage in any of these types of webinars and some of our expected impacts. We want to talk to you about tips for identifying leases because we also see this as a pretty massive pitfall with this standard. Third, we're going to walk into contract analysis, some measurement and presentation examples. So we're going to get you all the way from the example to the debits and credits. And then we're going to go through the operating lease, through a financing lease, and then some of the ideas on the measurement and presentation of pre-existing lease. What do we do about stuff that we already have sitting on our books today? Perfect. So an overview, and this is just a reminder, as many of you know, we did a leasing, I don't know if you were at this, but we did another leasing webinar that was a little bit more of the high level, and this one was designed to get more granular as we go through things. So in leases, under the new accounting standards, you're required as a lessee, and we are staying in the lessee space for the majority of this presentation, you're required to recognize all leases with a term of greater than 12 months at commencement, so at the start of that lease agreement, including your operating leases on the balance sheet now. So this is the big push of what's happening right now is we're taking everything that's characterized as a lease and all of it's coming onto the balance sheet. I will warn you, and we're going to warn this a couple of times during this presentation, when we say with terms greater than 12 months, you may have month-to-month leases that you fully expect to go past the 12 months that you'll still have to consider. So just because it's a month-to-month does not automatically get you out of the standard. What this model is trying to do is trying to provide a faithful representation of leasing transactions, and they're trying to go for consistency. For those of you that have been in the business for a while, we all know that many of our leases were written to get us out of capital treatment. Many of them were trying to get just below those measures to make sure that they're shown as operating because, one, those are a lot easier to account for, and two, the consistency under the income statement. But that was creating a lot of diversity in accounting. That was creating a lot of lack of consistency about what are you putting one lease on as a capital versus another. A lot of maybe game playing within the leasing arrangements in order to get a desired outcome. So essentially what FASB did is they said, we're going to try to strip all of that out and put everything on the balance sheet. So that's what we're going to talk about mostly today. We're expecting this to affect all businesses in the energy industry. However, some are going to have a much greater impact depending on how their business strategy is versus others. We have several utilities that we've already worked with or renewable energies companies that we've worked with before that have very minor leases. We also have some that have some pretty massive ones. So again, we expect it to impact, but how much is it going to impact you? Time will tell. We want to point out, too, just in case there's any in the natural gas or oil and gas side on this call, that any leases to explore the land for minerals, oils, natural gas, and similar non-regenerative resources are exempt from ASC 842. There's also some other exemptions within the standards, so I'd highly suggest you get in there and understand those, but this is the one that we will see hit the energy space mostly. Right, Danielle.
Thank you. So here's our first polling question. What is the best description of your progress thus far with topic 842 implementation for your business? A, we have processes in place already. Entries made and year end will take a little more effort. B, we have a plan in place but have yet to execute it. C, we have engaged or plan to engage an external accountant, however, have not identified the living being who will be helping us. D, we have engaged a firm of amazing experts. I'll give you all a few moments to respond. To respond, please click on the button next to the answer you choose and hit submit. If you can't see the submit button, please enlarge the slide area. We'll give you all just a few more moments to respond. And here are our results.
Perfect. So all over the board, it looks like, I think everybody can see this, that it's all over the board of what we've been doing so far. And it's an interesting one because there really is no right answer to this, but there probably is a little bit more of a wrong answer, which means what I'm trying to say is if you haven't started yet, you probably should, because this one could take some thinking about as you roll through the standard. All right, let's get into the minutia of leases. So one, financial statement impact. So what are we doing about leases? Well, in the past, we all know that there was these things called capital and operating leases. It's interesting because those have changed in. A capital has essentially, and there's some nuances here, but we're talking high level. The capital leases have gone to a financing lease, and the operating are staying the same. So in the financing lease, instead of a capital asset, we have this new term called a right of use asset, and we have a lease liability. So the balance sheet, other than some classification, stays very consistent to what we did before. We have amortization and interest expense on the income statement, again, very similar to what we've had before. And in the cash flows, any of the principal payments that go towards your lease liability are in the financing section, and anything else jumps up into the operating section of the cash flow. Essentially, when you think about a financing lease, what you're thinking about is if I had utilized debt, a debt instrument, to purchase this asset, we're following almost that entirely the same kind of classification on the balance sheet, the income statement, and the cash flow from that right. So again, financing was old capital. There are some differences, but essentially, other than some classification issues, it's essentially the same types of calculations that we've done, and we're historically comfortable with the past. In the operating side, though, the one and probably the most interesting difference is on the income statement and cash flow. All those remain the same as we've done before, but we're going to post this thing over to the balance sheet. And later in this presentation, we're going to actually show you the debits and credits and where everything ends up in the geography. But if you had an operating lease in the past, again, you're not going to have to change your income statement. You're not going to have to change your cash flow. But what you are going to have to change is bringing on that right of use asset and a lease liability, both a short and a long term, onto your balance sheet. And we'll talk about a little bit more practical implementation. One thing on this slide that I wanted to make sure that we noted is kind of this idea of these short-term leases. So at any time an entity, you might make a policy election in which you can continue to account for short-term operating leases, similar to under ASC topic 840, so aka off balance sheet. However, you have to be very careful with this short-term idea. So just because it's month to month or under 12 months or less, if you can keep it going on, or if you're anticipating that it's going to continue, then you still, or I guess the way is to think of it, if you're economically compelled to renew the lease beyond the 12-month term, this could actually create an operating lease. So just know, if you don't just discount the lease if you're under that 12-month period or a month-to-month. All right, so let's talk a little bit about implementation of 842 and some suggestions that we have. We really like to, making sure there weren't any questions. So when we like to do this, we like to break it down by phases. Because in our mind, when we think about how are we going to implement something as big as this leasing standard, if you try to do everything at once, you're going to get lost in the implementation. So what we believe is the first stage that we really want to think about is scoping and the assessment of the impact. So how do you know, and this is going to be a question that comes from your auditor, how do you know your population is complete? How do you know that you have everything, all the contracts that meet the definition of a lease in accordance with 842? Well, I can tell you right now, for the majority of the entities or the companies on this presentation, you're going to need a cross-functional team. You're going to need teams from in and out of different divisions, in and out of different sections of your company. So again, I think that developing that team today will really help you establish that roadmap and communication plan moving forward, because this is going to have to get into your general internal controls. You're going to need to compile that lease portfolio and assess that completeness. How do you know it's complete? And again, we believe this to be one of the biggest pitfalls that could anticipate, because I can promise you that I hope your auditors, when they come in and take a look, are going to be talking to people outside of the accounting department with some leading questions to see if this list is complete. And then you're going to perform that lease analysis and impact on key metrics and debt covenants. In the current area, the area of the debt covenant, this is something, if you're not prepared for it, could potentially impact those covenants. So you need to take a real in-depth look. What's also important to note in this area is that your debt covenants could be very different than another company's debt covenants. So getting into those lending agreements and really digging deep to see what those debt covenants state is important. So second, what we want to do, so that's almost the assessment of the impact in the current year. But we know that we have to have a system of internal controls, and this gets into phase 2. A system of internal controls is going to be something that can move us forward with time. How do we know when a new contract is signed that there is a lease or an embedded lease within it? Because again, you can't just, you're going to love this. So I was having a conversation not too long ago with a team that included attorneys, included disbursements, included accounting. And one of the individuals said, well, this is going to be easy to do this leasing, because we just won't call anything a lease anymore. We'll just have a different name in the contract. We'll just call it contract and no longer use the word lease. And that's one thing the standard has brought out is that you have to examine all contracts to see if they meet the definition of a lease under 842. So there may be some embedded options. So again, how do you know that's happening? How are you going to identify the systems and the processes and controls that need to be changed and or developed and implement those on a timely basis? How are you going to validate with your management teams and external auditors that processes and controls are properly, one, designed, and two, implemented? Are you going to determine, or when are you going to determine the adoption method and practical expedience, which I will tell you on the FASB side of the house, they gave us some great practical expedience that we're going to talk about. There may be some utilities on this call that this leasing is focused on FASB. We may have some GASB followers on the call. Please note, if that's the case, there's a lot of this is very similar, but GASB has its own standard that's being implemented in the current year. It's different. It's a lot the same and a lot different. So we'll note a couple of things as we go through. However, they didn't give us on the GASB side really any practical expedience like they did on the FASB side. So we do really appreciate the practical expedience on the FASB side, which we'll go through in a moment. And then there's going to be some additional disclosures. It feels like in today's day and age, we can't get a new accounting standard without added disclosures. Personally, I'm looking forward to the day when we actually get to take things off the financial statements, then adding things to. This is not that standard. So we need to assess what those disclosures are going to be, because some of them, you might not have the information readily in hand. 3, test and validate. So once you've implemented those systems, test and validate any new controls or any controls that are changed. And then, as necessary, performing data migration, user acceptance testing, and data validation. What this really gets to is the fact that we are looking at the data validation. We may use an external program. So there's a lot of leasing programs out there that'll help us with the calculations. They'll help us with the debits and credits when it comes out. Personally, and this is just the Julie Desimone pitch, if you have over probably 10 leases that you're going to have to account for, I would really look at potentially getting into one of those products. There's a lot of scalability within the products, and we're able to look at those products, and they just help with your documentation. They can help with your note disclosures, and they help with the debits and credits. Otherwise, this becomes a spreadsheet exercise, and we all know when we start with a spreadsheet exercise that tends to be small, the fact that these are long-term things in a lot of regards means that they're going to be very big with time. So again, consideration of a tool. So if we have that tool and it's feeding into financial reporting, what are we doing from a data testing and migration standpoint? Another point I want to make on this conducting education and training, this leasing standard is changing repetitively. So as we're getting into the practical implementation and the nuances of this accounting standard, FASB continues to implement changes to the standard or clarifications to the standard. So this is not it's not a one and done training. Yep, I know everything today, because we fully expect this to continue to be iterated over a period of time, and probably, quite honestly, over the rest of all of our careers. So completing that education and follow-up, I think, is incredibly important. In fact, on the GASB side of the house, we're just starting to implement, I think the 630s of 2022, or the first implementation period, they've already issued a new standard that's clarifying and changing some of the old standards. So before some of even our 1231s are implemented, it's already starting to change. All right, so let's talk a little bit about adopting AS 842 and where do we start? So how do we get this whole ball rolling? So one, ensure the leases under you, so you know what you had before. You know what you had either in your note disclosure on your operating leases, or you know what you've already had under your capital leases. Make sure that they're accounted for correctly prior to implementation. And what we mean by this is that if we think we did a good job on that prior to this implementation, then great. Let's leave it as it is. If you have any concerns about how you've, in prior years, assessed the leasing standards, this might be a great time to go back and revisit that. Go through a listing of leases and contracts that involve regular disbursements to identify any potential leases. So again, this is getting to the completeness of the population. How do we know that we've got everything? Well, looking at any time that you've had a series of payments, that one is a good identifier that it could contain a lease. Not does, but could. Review and analyze the contracts and invoices to determine if there's an identified asset. So have you had that identified asset, and is there the right to control? We were talking just the other day, and it actually came up to be, what about, we were looking and there was a payment stream. We're going to get into materiality later. But there was a payment stream that was for uniforms. So uniform for parts of their crew. So these uniforms are actually owned by a service company, but they're dropped off. They're actually going on the person at the company. And I'm pretty sure if you have the right to control the asset, if you've got a human that works for you that's actually wearing the asset on a daily basis. That's a pretty good indication of right to control. So again, these are the types of things that came up, not necessarily in the contract, but just looking at these invoices that were happening on a monthly basis and really kind of thinking back into those invoices. And then please, please, please review all the applicable practical expedients and elect expedients to apply. And we're going to talk through those, and especially the ones where we would highly suggest that you do moving forward. Perfect. Okay, here we go. Practical expedients. So again, we thank FASB for giving us these practical expedients. They're very helpful, and personally, my favorite is this very first one, the transition election and the package of three. The most important part of this package of three is all three of them have to be implemented at exactly the same time. You can't do one and not the other. So this three At adoption, you have to do. In fact, I have not yet found a client that is, one, not adopting or had a really good reason not to adopt this. I'm sure that there's reasons. I think that they're few and far between. I think that's the way to say it. So at adoption, what the transition of the package of 3 says is that you don't have to reassess any expired or existing contracts for any embedded leases, proper lease classification, or capitalization of initial direct costs. This is huge, and this was a massive win when we think about our standards. So let's pretend that your year end is December 31st, 2022. In the practical experience, what this says is if you implement this and say, yes, we're going to do it, that you don't have to, what you put, as long as they're not wrong, what you've put on your books as a capital lease comes straight over as a financing lease. What you put on as an operating lease will continue as an operating lease. You'll have to do something in 2022 to the operating leases and some classification differences in the financing leases, but you don't have to go back and look at all of your existing contracts and determine if they meet the definition of a lease. You don't have to try to look at the embedded leases that could be within your contract. This is massive for us. And then they changed the way the initial direct costs now work. We don't have to reevaluate any of that in the past. So the only thing you would start with is you would take anything that happened in 2021 and before, you move those capital leases to financing. Again, you'll have some classification differences. You'll move the operating leases to operating, which means you're going to have the same P&L and cash flow impacts that have a balance sheet impact in 2022. And then you move forward to the assessment of leases starting January 1st, 2022. So one thing I didn't point out that I think is important, they did change the definition of a lease in ASC 842 from ASC 840. So that's an important classification to meet. So what you're going to be doing is any contract that you enter into as of 1/1/2022, that's where you have to apply the new leasing standard, the new leasing definition, and how everything works. This is a big package, and again, I think I would highly encourage everybody to really think about implementing this. There's also some additional practical expedience for land easements, so we don't have to go back and reassess whether an existing or expired land easements contain a lease. We're going to talk about that a little bit later on. You may elect to apply hindsight to existing leases. What I know today is what is, rather than look at what could have been. So hindsight. Short-term leases, a lessee may elect to exclude leases of 12 months or less from the new accounting requirements, but as we've already talked, that's a pretty slippery slope because we have to look at whether or not that's expected to continue past the 12 months. There is a capitalization threshold. Immaterial leases don't need to be accounted for. Please, on this one, if you are going to take this, we have this conversation daily with our clients about immaterial leases. Most companies are going to say, we're not going to try to do all this work for immaterial leases. But we have to think of it in its own instance and leases in the aggregate. So when an auditor comes in, we still need to have a listing of what these leases are, and how do you know that as a whole, when you aggregate all this stuff, how do you know it's still not going to have a significant impact on your balance sheet? I highly recommend that if you have leases that you're going to put into your software or into Excel, you're going to also have a second tab on Excel that says, here's our immaterial, still list them, and then how have you identified that these are considered immaterial? Because even if you have a lease that's not material, but you have 500 of them, it could impact your company. Under the practical experience of lease and non-lease components, lessees and leasers may make an accounting policy election to choose not to separate both the lease and non-lease components. When you get into that, think about this practical expedient. And then the discount rate. There's also a practical expedient that says if the implicit rate is readily determinable, that rate is required to be used. Otherwise, incremental borrowing rate or private companies may elect by class of assets to use the risk-free rate of return comparable to the lease term. We've actually found, and we'll get this later too, we've got a couple of things on the discount rate. We've seen instances, and we don't actually know the answer to this right now, where maybe you have a very, very long-term lease, we found that the risk-free rate only goes out, I think, 30 or 35 years. Brad, I know you want to chime in on the discount rate.
Yeah, so I just wanted to cover something that I get questions for a lot. People just ask, what does implicit rate actually mean? And the best example I give is for vehicle leases. Most of the time they have a rate actually stated in the contract. That'd be the most obvious case. And then another point is that using the risk-free rate or treasury rate has a undesirable effect in terms of raising your liability. If you were to use what your realistic incremental borrowing rate would be, just due to the arithmetic of the net present value calculation, a higher rate's going to give you a lower starting liability. Lower rate's going to give you a higher starting liability. But that was all I wanted to mention. Perfect.
And I think that just be ready, and then this is Brad, those are great points. And be ready though, as you're walking into this, these are some of the questions your auditors are going to ask you about, because our risk from the audit standpoint is that the liability is under. We want to see, not that we want to see, we want it right. But there's going to be some questions like, how did you come to that? I would highly recommend, as you're going through this, whatever rate that you determine is right, document what your thought process is behind it, because we have gotten to the point where we've got clients, 6 months, you come in and audit 6 months down the road, and we ask why, because that's what we're supposed to do, is ask why. Why did you use the implicit rates, actually? If it's readily determinable, is the easy answer. But why did you use this rate over that rate? And it's interesting when, trying to remember back. So as much documentation of your thought process as you're going into some of these judgment calls that you can do at the time that you're actually making these calls is going to serve you very well in the future. Danielle, polling question number 2.
Thank you, Julie. Upon adoption at January 1, 2022, practical expedients allow any pre-existing easements or right-of-way contracts which were not accounted for as leases under historical GAAP be accounted for. A, as if they are a lease. B, as one-time expenses in year of implementation of ASC 842. C, in the same manner that they were accounted for previously. As a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 5 of the 6 polling questions.
And then while they're answering the poll, I just wanted to cover a question that came up about the rate. Someone asked what rate would make sense on a long-term rental or office space. If you're using the incremental borrowing rate, the rate you're supposed to be using is essentially what rate a bank would charge for a mortgage of that asset or a loan on that asset. So it may not be easily determinable. Otherwise, if you use this practical expedient, you just use that term of that office space lease. It's a 20-year lease or 10-year lease, and you would use the 10-year treasury yield, and I believe it's the constant maturity yield is the table you want from the Federal Reserve's website, if that helps. But that rate is all you have to grab. It makes it, what Julie said, it does make it very auditable and easy to determine. And you would pick a different rate for every single lease that you have based on that term.
Perfect.
Thanks,
and
Brad,
I think, oh, sorry, can I answer one more thing? So I was
absolutely.
Thanks. I was also going to say, you're not locked in. If you can use a different rate, you're not locked in to just use one type of rate for every single lease that you have. Now, there is some identification class of leases and ping-ponging back and forth that just for your most advantageous thing probably is not the greatest. But again, you can make a different decision on classes of leases if one makes sense over the other. So just want to note that it's going to take some documentation as to what's reasonable and rational, but wanted to point that out. Danielle, sorry.
I am just going to forward us on to our results, and here they are.
Perfect. I think most people got this. It's C. So again, if you take the practical expedient, it's the same as they were accounted for previously, which in a lot of easements or right-of-way contracts is just as you make the payment, it goes into an operating expense. Or if it's all paid up front, which then it wouldn't be a lease anyways, it usually goes into capital. All right, let's move towards the next part. So it's important to note, and we probably say this way too much, but we think it's important to note, how do you know a contract contains lease? So this is the primary change between the old ASC 840 versus 842. Like, what is the difference between what a contract contains a lease? Again, you have to look at every contract that you have and whether it potentially can contain a lease. And the two pieces are, one, whether it has an identified asset, and two, whether it has the right to control the use of it during the lease term. This is a little bit different on the right to use to control, because there used to be an element of physical control, and that has been taken aside. So it's really, can you control the output of the lease? So let's dive into a little bit more on the identified asset. This really gets into whether there's an explicitly or implicitly specified asset that you can point back to. Great example is when you have a purchase power agreement with a wind farm, and that wind farm is specified, absolutely. But probably the key distinction that you need to spend, especially on PPAs, if you do have an identified asset, what you need to really think about is the substitution right. Does the supplier have any practical ability to substitute? And it has to not be economically beneficial for them to substitute that asset. So in a lot of purchase power agreements, wind farm, solar farm, other purchase power agreements, they might have an identified asset, but under that purchase power agreement, there may be clauses within that says if you can't hit the minimum because maybe the wind farm goes down or the wind's not blowing that day, that they are required to substitute from somewhere else that power, then that substitution right needs to be analyzed to whether that is truly an identified asset. There's a lot of meat in the substitution right, so it's something that we have to make sure to think about, and something that we have to delve in pretty deeply. So a couple of things that we can think about is that benefit from exercising that right. If there's a reason that you've got an example, maybe there's no good benefit, maybe it's in the contract for the supplier to actually do that they can say, no, well, we could substitute it, but it wouldn't economically benefit us, then it still is an identified asset. You can't use the substitution right. But in many cases, especially I think with the newer purchase power agreements that we've been writing over the last several years, we're seeing a lot more of that substitution right actually in the language to those assets. So again, purchase power agreements, major one. I'm going to say this again a little bit later in the presentation, but something that we need to think about. So once you get past the identified, that's kind of the, I would say, easy kind of first one to identify. If you can get past it, yes, it is an identified asset, then we need to understand what the right to control that asset is. So what this means is that the customer or the lessee has the right to direct how the asset is used and for what purpose it's used for. So it includes the right to change how the asset is used throughout the contract term. In prior standard, that really got to, if it's a solar farm, can I change the physical aspects of it? That's not what we're saying anymore. What we're really saying is, how am I using the output, and can I change how that output is used? So it's a much more broader concept in today's, whether it contains a lease, and something that we need to really dive into. Now, is this black and white? If any of you, and I know there's a lot of you that have already started diving deep into the standard, no, it's not. There are definitely some leases with the black and white nature. Let's go back to the uniforms. It's pretty black and white that there's an identified asset. We know the uniforms that are going to be on the human's bodies, and we know that when it's on the human's body, you pretty much have the right to control that during the right to control that asset. That's an example of it. Now, could you argue the other side of it? Yeah, there might be an ability to do that. Substitution rights, you have to have just that one uniform. Is there practical substitution rights? Something we need to think about. So we might have more black and white examples, but there's going to be a lot of gray areas in this, and that's where you have to really dive into, does this make sense? And again, there is going to be some judgment in this area about whether a contract contains a lease. Consistency in documentation and keeping, especially in the judgment areas, documentation near thought process is going to be key, especially when it comes to audit time. So we highly suggest that you have some sort of a Excel schedule or something that walks through these points of each of your contracts and why or why they do or do not meet these definitions. All right, so common contracts that I should say that could contain a lease. They don't all have to contain a lease, but something to look at, if you're starting stage one, look into these areas. We often see it in transportation. We often see it in leased vehicles in transportation. Vehicles, I just said it, purchase power agreements may or may not. I do want to put a push out, a clarifying point. This is the one that FASB did a little bit differently. They actually exempted purchase power agreements for the entire leasing standard. So if you have somebody on the lease, the FASB side that you might be looking at their financials and you don't see any of their purchase, it's because there's an exemption there. They do not have the same exemption on the FASB side. We have to go through what we just talked about on the purchase power agreement side. Certain easements, if you have easements that you're paying for over time, then those are ones that you have to take into consideration. And we've started to see some on storage or battery arrangements. So there's a lot of different arrangements out there that we've seen quite a few embedded leases into those contracts come into play. So we have to assess whether these types of contracts and all the other contracts are leased or if they can contain an embedded lease. And there might be a piece of that contract that we have to bifurcate out, so we have to take out and treat as a lease, where everything else would just be generally a general operation. Love those embedded leases, Brad. They're my favorite. I'm being very sarcastic right now, just so everybody knows. And I will say with the embedded leases, those are the hardest ones to find because they're kind of a lot of times hidden within all the contract language. Danielle, I'm going to let you take it. They are. They're embedded. The definition, I just gave the definition of embedded, hidden. Danielle.
Great. Here's poll number 3. Based on this info, how many contracts does your business have that require further analysis to determine whether they qualify as a lease? A, 1 to 10, B, 11 to 20, C, 21 plus, D, more than I'm able to count. It's come to our attention that some folks are having trouble viewing the polls, and I would suggest refreshing your browser, hitting F5 on PCs or Command R on Macs. And if that doesn't work, if you could please try exiting and logging back in. We do also suggest using Chrome or Firefox. Thank you everybody for your participation, and we'll give you a few more minutes, or I should say a few more seconds, to input your responses.
And another question came in asking if the easement is in perpetuity. My understanding is that it is excluded from the lease accounting. Is that correct? That is correct. They're called evergreen. Sometimes they're called evergreen contracts where they essentially automatically renew forever. Those are excluded from the lease guidance.
Yeah,
usually they have a starting term.
Oh, go ahead.
So. No, you can go ahead, Julie. You're on.
No, I was going to say because the vast majority of those, you just don't know when they're going to end. So how do you, and we're seeing some of those on the hydroelectric side too. So just with those long, but we're also seeing on the hydroelectric side, like 100-year leases, which are just crazy. They could be little dollar amounts, but 100 years of present value is a big number. And there's no risk-free rate of return on a 100-year project, Brad. We can't find it. So.
That's right.
Here are our results.
And on the opposite end of that, month-to-month leases, in the end, the guidance is just trying to bring on your minimum contractual liability. And with a month-to-month lease, I've yet to see where someone was confident enough that they could say, it's month-to-month, but we know it's going to be a year with enough certainty. So I would err on the side of just calling it a month-to-month lease, unless you're very, very certain that it's going to be a certain period of time, and it has to be a specific period that you choose.
But that will be a conversation you'll be having with your auditors. I can guarantee that. Perfect. Thanks, Danielle. So we've got a hodgepodge, 1 to 10. So I would consider we should ask a follow-up question, Brad, on this one about, are you going to consider using some sort of outside of Excel to account for these leases? Especially in the D category, if you're not, good luck, Godspeed. I hope that everything goes well in the implementation of your leases, because it's going to get complicated in Excel fast. It's like the asset retirement obligations, 20 years later in Excel. Perfect. Okay, so now we're going to hit some nuts and bolts. We want to get into some specific examples over the next 45 minutes of really the debits and credits. So I hope everybody is well charged, has their caffeine in front of you, because we're going debits and credits, which is going deep. So let's start with example 1. So renewable energy company, and by the way, we made up these examples. Some of them, they're all going to make sense from the leasing, but just give us a little grace with there's one with whether or not, just give us some grace. Hopefully these all make sense from a wind production and production. So let's get into it from the leasing. Renewable Energy Inc. is a wind producer. They entered into a 2-year contract with Crane Management. So they bring out the cranes to construct the facilities, to provide the crane rig and a crew. So they're bringing out the crews to operate it for the purpose of installing the wind farm. Crane Management will deliver the crane to the wind farm. The contract outlines specifications including minimum performance capabilities and working conditions. Crane Management is also obligated to maintain the crane and to keep it operable. This is the one that, give us a little grace on this one. There's no other crane that would be practical to be used to fulfill the contract. That might be a little bit of a stretch, but listen to this one. Let's just pretend that's the way it is. There's no other cranes that are practical to be used to fulfill it. And Crane Management could not source a substitute crane within a reasonable period of time. That one could be totally true, because they may be a long ways away and they may just not have the inventory able to do that. This will be operated by Crane Management employees with expertise and competence under the supervision if the whole plant is being supervised under Renewable Energy Company, Inc. RE Inc. has the final authority to direct which wind towers to build and when it occurs, and whether the methods to complete the towers are acceptable. And then standard downtime and safety regulations are not indicators of directing the use of the asset. So let's ask the question, do you believe, oh, sorry, I just stole it from you, Danielle. I'm going to steal it from you. Do you believe that this appears to contain a lease? Yes or no? Should I do the Jeopardy theme song now, Brad? Is this going to contain? And I hope that everybody was able to start seeing these polling questions. And again, if you haven't,
maybe the Top Gun theme song could be played.
Because I will say, Brad, just for everybody, because you all are highly interested on this. My son is actually coming home from school this on tomorrow. I get to see him tomorrow and hug him. It's going to be great. But I do fully intend for both Top Gun movies to be watched this weekend. And if he balks at it, he doesn't have a choice, because I'm paying for his school and his apartment. So that's how I'm going to make him watch them with me. Perfect. Yes. Okay, so most people say that yes, this appears to contain a lease. I would also agree, but there are some nuances to think about with this. It's not as straightforward, or it's generally straightforward. So it may contain the lease, and I think it's fun. We always do the may, because I think people can think of certain situations that it might not. But we know that the crane is implicitly specified in the contract. It's going to be the crane that gets delivered and used. Once it's delivered, it's impractical to substitute the crane unless it becomes inoperable for an extended period of time. So, I mean, why would you build one of these cranes up just to, take it down and bring another one in? This may be, when we keep saying the uniform example, this substitution on the uniform may be the argument that you have to them, because is it easy to substitute a uniform? Yes. Is it easy to substitute a crane in the middle of nowhere building a wind farm? Not really. So the other thing, does RE Inc. have the right to control the use of the crane throughout the contract? Are they going to obtain substantially all the economic benefits of the crane during that time period? I think the answer to that would be a yes. And do they have the right to use and directly use to the rig? Yeah, they're going to tell you which one the wind tower to go and where it needs to be and how it's going to be utilized. Though we have to note that the operator's expense, so yes, we would agree that under the situation we just ran through, that would be a lease. And then the operator's expenses would be treated as a non-lease component. So this is where you bifurcate those out. You only do the stuff that's to that crane building, and then those operating expenses would just be as you would normally pay operations expenses. So it's important to note, I think one of the keys to this is to the substitution rights. In this example, we're saying no, that it's not going to be easy or practical to substitute. But there's a kind of a two-prong approach. You have to have in substitution rights, it's actually considered substantive substitution rights, and it has to be both practical and economically beneficial to the supplier. If we're unable to say whether the supplier has a substantive substitution right, we have to assume that they do. So if we don't know the answer to that, or if it's in the gray area, the standard actually says, oh, we're going to assume they have that ability to, that has the substantive substitution right. Or it's not substantive. I said that backwards. Okay, stop for a second. I just said that backwards. I'm sorry. So if we're unable to readily determine whether a supplier has a substantive substitution right, the customer shall assume any substitution right is not substantive. Okay, just sorry, I had to make sure I said that right. So again, if you get into this substitution, get back into the standard and read through it because it's a big deal when we're talking about this. But for this, we're saying it's not, and we defined it as lease. I'm sure I made that as clear as much, hopefully. Hopefully you can follow me on that one. All right, let's get into example number 2. So battery services, a service specializing in energy batteries, enters, and we're seeing actually more of this, so it's interesting, enters into a 3-year service contract, might be more, might be less, with Transmission Inc. for installing and maintaining services, sorry, I'm going to cough, excuse me, for several of Transmission Inc.'s battery sites. Optional 1-year term extensions are available. Both battery services and Transmission Inc.'s approval is required to extend the term. There is a monthly service fee charged for the services along with the additional fees for chemicals used. This is the one I wasn't absolutely sure if there's a chemical in batteries, so just give me a little grace on the chemicals. I couldn't think of anything else that I needed to have in this to make it work. So let's just assume there's chemicals. They do charge that from time to time, and there's an additional fee for that. Battery Services agrees to make the batteries available. They're going to be kept in working condition and capable to store electricity to the required specifications, to be used solely for Transmission Inc.'s needs and to meet the specifications as stated in the contract. Battery Services also hold standards rights regarding duty of care, including the ability to substitute equipment when needed for maintenance or repairs. All right. One instance is, oh, well, no, I'm going to give myself away. Let's go to the next polling question. Oh, Danielle? Oh, there we go.
All right, here's our next poll. What is the term of this lease? A, 3 years, B, 4 years, C, doesn't matter, it isn't a lease. Just a reminder that you do have the option to submit questions for us by using the Q&A window. We have quite a bit of content to cover today, so if we don't have time to respond during the webcast, we will do our best to follow up with you afterwards. Give everybody a few more moments here to respond.
And Julie, a question for you. Someone asked, if a substitution right is substantive, would this example not be a lease then? And
so if it
maybe
is
that's something we can incorporate into our answer.
Yeah, absolutely.
And here are the results.
Perfect. It doesn't matter. It isn't a lease. And we did this on purpose. This one's actually got quite a bit we have to dig into it. And I think, Brad, to your point, substitution rights is going to be the biggest piece of this, and diving into what do we determine whether or not there's substantive substitution rights. If there is considered, when we got back to the identifiable asset, if there is substantive substitution rights, then it is not considered an identifiable asset. So then it would not meet the definition of a lease. However, there is some gray area around that substantive substitution rights, and I think it's important to really think through that as well. So in this one, we actually made it a little bit gray area as to whether those substantive substitution rights. We did that on purpose because we want you to see that you could probably go either way just with what this, what we put in the case study. What will be interesting is when that's a case of where now you got to dive a little bit deeper into that contract and then make an assessment if you believe that it gets to the substantive. Is there enough of that to say substantive would be the case? So again, I think in the case study, especially with the maintenance, I think the one key maybe to this is that they can substitute it when needed for maintenance and repairs. There could be an argument, does that get you enough to the substantive? So you're going to keep those batteries. If they might take them out for repairs and maintenance, but bring those ones back. You may not have a substantive, that's a hard one to say, substantive substitution rights. But if they could just willy-nilly bring these things in and out so that they're keeping, you might say, yeah, there is, and there's no identified asset. So it'll be digging into those contracts a little bit more to hopefully help clarify. I will tell you, though, there's a lot of cases where that clarification is not there. And so that is where you're going to have to get back into the standard and really document how you feel about it, where it fits into the standard. All right, so let's assume it is a lease. Let's go to the maybe a lease or potentially a lease. We had it split right at 3 to 4 years, which I think is fantastic. But let me see. Let me go to the next point. Okay. So this point is the contract may be, and you're going to love it because all of our answers may be contained in a lease if the batteries are one component of the services contract that gives the transmission a right to direct the use. So we kind of have the right to control. I think regardless, we have that right to control in this case study or in this example that we brought forward. The substitution rights included, and this is where we didn't give you a lot of information, but we're trying to open up that thinking. The substitution rights included are merely operational or practical in nature and not substantive. So again, if it's just operational or practical that they did this, but those batteries are really your batteries, then generally that would be considered non-substantive and it would be considered a lease. The battery services hold some rights, but not rights to which overcome transmission's rights to direct the use of the compressor. That was supposed to be batteries, sorry. I didn't change that term. I knew there was going to be at least one of these in there. So again, we need to do some analysis. We need to dig deeper on these. When we think about the 3 to 4 years, one thing that you need to keep in consideration, because this is going to be another big judgment call, I think, when we start talking about lease terms. So if let's just pretend we got past the substitution rights, we've determined it's not substantive, therefore it is, we do have an identified asset, therefore it is a lease in this example. And the next thing we need to do is at 3 or 4. Well, if the lessor controls the option to extend, you presume that you're going to extend. You're on the lessee side, right? So the customer, the lessor controls it. Presume that they're going to extend it. If the lessor, though, however, controls the option to terminate that lease, presume they will not terminate. So it kind of works in the lessor's favor. So it's really getting you to extend that lease. So I would say, and Brad, tell me if you think I'm wrong, but I would say in this example, let's say that the option to extend is at the lessor's level, or the termination, it would be a 4 years. However, if those are not right, then it would be a 3-year lease.
Yeah, and I would just say if it's required where both parties need to agree, then typically you go with no extension, unless you're very certain that both have an incentive and are likely to extend it, then you would just go with the minimum.
Yeah, I think that's a great point, because I think these are like gateways. These are how would we think if we just don't know? But the leasing standard specifically says that if you can make a more probable assumption or a reasonable and probable assessment, then you go with that reasonable and probable assessment.
And they have said what's been interpreted to mean a 90% certainty. So reasonably certain is accepted to mean you're 90% sure. I know that's hard to assign a quantitative number to a qualitative decision, but the gist of it is you have to be pretty dang certain of the term before you are going to presume that that option gets taken.
I'm actually looking kind of forward to this in some of our clients, because I'm waiting, Brad, for that first 90.1% certainty that we're going to see in some of our documentation. Yes, we believe it to be 90.1% or 90.0005% or something that's just over that 90%.
Yeah, maybe some of the auditors do like 94 or 95.
Yeah, exactly. So yes, so again, it's going to really depend. When we look at it, so this, I would say if we were backing up a little bit from this example, again, case study, or in this one, substantive substitution rights, something we absolutely have to address. I think the use of the asset is pretty explanatory in this one, that one hit home, but it's the identified nature. And then if you do determine it's lease, it really gets into that lease term, which has a significant amount of, or can have a significant amount of judgment that, once again, we want to make sure that you're documenting. So let's talk a little bit more through determining what these terms are. And this is just something straight from the standards, and we're hoping that you can take our PowerPoint and use it as a resource. So there's quite a bit of information in here, especially when we get into the debits and credits. But in determining its term, if the term is non-cancelable, there's a non-cancelable period plus any periods covered by options to extend which are controlled by the lessee if the lessee can reasonably be certain to exercise that option. So again, I think the key to this is a lot of these decisions aren't made in the accounting department. You know, if you've got a vehicle lease that has a 5-year term with a 3 1-year options, it's probably not somebody in accounting that's going to determine if it's reasonable that you're going to extend that truck. Now, in most cases, especially let's play on the utility side, those trucks are usually equipped in a different way that, yeah, you're going to want to extend them as long as you actually can, because you're not going to want to have to go through the cost of re-equipping a different truck in general. I'm not saying that in entirety, but in general. So these are conversations that you have to have. We know if it's non-cancelable, if the lease term is non-cancelable, obviously, right in there. But if they are having these terms that come out past that, then we really have to assess whether or not do we have the ability to do that. If we have the ability to do that, are we going to do that? Can we be reasonably certain? And this gets to Brad's 90% mark. And then where's the termination? So to terminate, which is controlled by the lessee, so by the customer, if the lessee is reasonably certain not to exercise that option. So if you have a termination that you can do, but you doubt you're going to do it, or history would suggest that you haven't done it, then at the end of the day, you're going to go ahead and add those periods into the lease term. And then to extend that are controlled by the lessor. Again, what we were just saying in the last slide. If you've got the lessor gets to make the decision, you're going to assume that they're going to either extend the lease and not terminate the lease unless you know or otherwise. So an important note on annual or monthly renewals as well is a lease is no longer enforceable when both the lessee and the lessor possess the right to terminate without permission from the other party with no more than an insignificant penalty. So this dual cancellation clause or termination clause, it has to be both sides. And it has to be that there's nothing in it that's significant. If you're having to pay a significant portion of that contract out with the penalty, that's economically not going to be what either side is going to want to do, and you have to assume they're not going to do it. So again, if that right to cancel or terminate from both sides without an insignificant penalty, that kicks it right out of the leasing standard. We see some of those. This can actually help potentially. Let's go back to the uniform example. If you didn't, let's pretend there wasn't substitution, substantive substitution. But if you have the uniform, a lot of these service contracts we do see the cancelable clauses. But in our big leases, over equipment, over trucks, vehicles, that type of that could get. Statement presentation, and again, I this or any time on this, but we talked through the difference between now we're going to have two classifications: the operating and the financing lease on the lessee side of the house. There is a difference. You look at the balance sheet impact. What gets different is your cash flow, and well, your cash flow stays. Cash flow is your cash flow, but where you put it, section of cash flow. And then your income statement is probably the biggest driver, the biggest difference. Leases are going to have income or amortization from the receipts. Let me know if it continues to pan. Pick up. Does it still sound like I'm?
Now I hear you a lot better, Julie.
We may want to jump back and cover that last slide one more time, Julie. It looks like we're having a little bit of technical difficulty.
How
Brad,
about I
do you want to
just
jump in here?
take it over? Yeah, sure. All right. So what Julie was basically going over was the financial statement effect of operating and finance leases. Operating leases will be virtually the same outside of the balance sheet, bringing on ROU assets and finance lease liabilities. In the finance leases will be treated the same, but instead of being called capital leases like they were before, they're now called financing leases. I guess they wanted to change something, and so they went with just a name change for the most part. So going off of is this contract a lease example, or continuing it, this gives some specifics about the contract. This is a 2-year contract with equipment delivery on January 1st, 2022. There's a monthly payment of $1,000 at the end of each month for the battery. Within that payment, there is a $900 base rental fee and $100 maintenance fee. After 12 months, it escalates to $1,200. Using the risk-free treasury rate, after electing our practical expedient, the rate's 4%, and doing a Excel formula gave us a net present value of $25,285. The quoted value of purchasing this equipment, this compressor, should say batteries, was $40,000, and then there were no lease incentives or direct costs. And then, so our first step is we determined it was a lease. Now we have to determine what kind of lease. This kind of helps walk through the analysis we're doing for our services. The transfer of ownership does not occur at the end of the lease term. They're now essentially purchasing it. There's no option to purchase it. So there's a no there. And then you have to ask if the term covers the major part. Another term that's been accepted to mean 75% of the remaining economic life. Considering that what our term is likely to be with the options, 3 years, we're deciding that that's not a majority of the battery life. And then the next one is another quantitative comparison if the present value is less than or more than 90% of the fair value. So our fair value was 40,000, and our present value is 25. And then there's a new criteria at the end there that says if it's of such a specialized nature that only a lessee can use it, only the lessee can use it, then you would call it a finance lease. And the reason that is they're saying if you're the only company that could use this asset, you're really getting all of the benefit from it. So if they had to, I don't know, modify something to specifically fit only in your structure or your property that's kind of useless to another party, then it would be a finance lease. And so this helps show high level summarized income statement and balance sheet effect. You'll notice that the lease expense, whether this was under 840 or 842, the lease expense should be a straight line lease expense. And it's kind of a good check figure when you're going through this to say, does my expense equal what it did before? If I was following the old guidance, which was just simply adding up your payments, dividing by the number of periods, and that's your rateable benefit or expense you're recognizing. Your right of use asset will equal the present value you bring on in your liability. We broke out the current and non-current portion there to show the next 12 months, how that looks. And then in terms of operating cash flows, the lease payments indirectly are in the operating section because your lease expense will be in your net income. This one is going wacko. But when you reconcile your net income to your operating cash flow, any liabilities, short-term payables for your leases, essentially keep that in operating. And this helps show how to get to that number. So you'll see our straight line rent here was that $13,200, which was just our $26,400 divided by 2. Our cash payment is $12,000 and $14,400 each year, so that is not rateable. And then we have our RU asset, which the rate at which the RU asset goes down is not very intuitive from the mechanics of it, but an easy normal formula for it is straight line interest, straight line expense less your interest component, which is your lease liability times your interest rate. The only time that will not be the formula is on our next example, which is when you have any deferred rent rollovers or indirect costs. Okay, sorry.
Perfect. Danielle.
And Danielle, all right.
Great.
Oh,
It looks like
here you,
we've got
Julie.
poll number 6 here. Compared to the previous lease guidance, operating leases have an impact to which financial statements? A, balance sheet, B, income statement, C, both balance sheet and income statement, D, none of the above. And for those of you that would like a copy of today's slides, you can download them from the folder that says slide deck and handouts. We will also be sending the slides via email tomorrow, along with a recording of the webcast.
Danielle, can you hear me okay again?
Yes, you sound great.
Okay.
Yep, Kristen.
So sorry about that. Brad, wingman. This is the definition of wingman, stepping in.
Let's just hope I don't die.
Yeah, you're not Goose. The wingman. There you go. We're going to think about the second movie, not the first one.
That's right, yeah. Second Goose.
Second Goose.
Goose 2.
We'll give everybody a few more moments to respond.
And this is just asking, I should have said, have the most impact to which financial statements? Balance sheet or income statement, both, or none of the above?
Wonderful. And here are the results.
Perfect. All right. So I believe the answer to this one. So yeah, I think we had a lot that probably responded prior to the Brad's clarification. So again, yeah, there is going to be some changes to both the balance sheet and the income state when you think about classification. However, in an operating lease, the largest impact, most significant impact is going to sit on the balance sheet side. So don't want you to completely.
The goal of the FASB. The goal is just to not have any P&L impact with this guidance. Its purpose was to bring on off-balance sheet liabilities and assets. And so they designed it to keep that straight line expense virtually the same with some other nuances. So there's small changes, but overall, it's really your balance sheet that is changing, and they're amortizing that asset and liability down in a way that can be a little confusing, but it does get you to the same kind of spot. Sorry, continue, Julie.
Perfect. All right, let's move over to a financing lease example. And again, what we're trying to think about with these financing leases is really, what if you gotten a loan agreement? I'm not sure that's English quite, but what if you obtained a loan agreement with this and debt? And it's kind of trying to match those principles crossed in the financing lease. So let's start with an example. So we have a 3-year contract with delivery of the vehicle on January 1st, 2022. So even if you apply the practical expedient, we're still in that period of needing to assess this contract. Yearly payments are $15,000 at the end of each month and $1,000 in maintenance fees. You're going to assume that your incremental borrowing rate is 3.3%. Initial present value of those payments is $45,000 with fair value at $47,000. And is accounted for as a finance lease due to the net present value exceeding 90% of the fair value of the vehicle. So that's what gets us in. There is, in fact, when you do have to assess between operating the financing, and we didn't dive we've got a lot of examples to go in this webinar, but there's 5 different steps that you go through to say whether or not it's a financing versus a operating lease. And of those steps, the 90% of the fair value of the vehicle, we hit that step, therefore we jump right into the financing lease. So this is a financing lease. And Brad is going to walk you through, if we bring this set of examples, what would the JEs, what would the journal entries look like, and the debits and credits?
Yep. So it looks a little daunting at first, but it's simpler than it appears. So you have 2 components now on the income statement, which is actually, I shouldn't say now, before it was the same. You had basically a fixed asset you were bringing on with your capital lease and depreciating it or amortizing it. Now you have an amortization of a right of use asset. So that fixed asset you had before now is called a right of use asset. For financing leases, you do differentiate the 2. But you have the amortization of that asset, and then you have the interest expense effect of that gets accumulated from your liability being multiplied by your interest, just like a debt amortization. And then in the operating cash flows, you'll see interest in there, indirectly, I should say, in your net income, but it'll also have a non-cash. You'll have a non-cash interest disclosure and cash paid for interest disclosure. And also keep in mind, in your footnotes, a lot of these figures are disclosed there as well. So maybe sometimes people do. It's not required to put that all in your statement of cash flows, but some do. And again, this is a 3-year vehicle lease. Annual payment of $16,000. We use 3.3 as our interest rate. And then we'll get into the kind of debits and credits of it all. Sorry, 1 second. So we have our payment of $16,000 there, and then interest. Julie, could you take over for just 1 second? Sorry.
think we're having a little bit of a technical difficulty again. Julie, are you
Oh,
there?
yes. I was talking to myself apparently because this mute, unmute. You would think after 2 years of sitting in COVID, we could learn how to unmute ourselves. But can you hear me okay right now, Danielle?
Yes.
Oh, perfect. Okay. Real quick, so the debits and credits on this lease payment and expense. So you're going to have a debit for the interest expense of the $1,482. You can see where that's calculated in that interest classification. But you're also going to have the amortization expense, and that is really for the right of use of the asset. So that's that straight line over the use of the asset. That's really that you're going to be able to use it. And then you're going to bring out the piece of the lease liability that it goes with time. I think the one really important part of this, and this is the same as when we did the capital lease before. Again, the only time these things are the same is on day one, or I wouldn't even say day one, moment one. And then you start looking at each of these, the right of use asset and the lease obligation differently. So then you start accreting that or bringing down through the amortization expense on a straight line basis. And then the lease liability will be taken out over time with a component, as we've done before, in interest, and then the component of the 14,518 as a piece of our principal. So that then brings us to an entire credit of cash. So the difference between this example and our operating example is that entire $16,000. Oh, yeah, the accumulated amortization too at a $15,000. But that would have then had a P&L, the operating expense impact. Now we have this interest expense. So we have it classified both as an operating expense and as a non-operating expense because we're assessing that we really were getting debt over time, or that thought process is debt over time for this loan, or for this lease. Use the right L word. All right. Excellent.
All right, I'm back.
So let's go. Oh, good. Let's go to the next example for a pre-existing operating. So this was the one we just did was brand new. So you're having to go through all the assessment of that, think about all the terms and whether it meets the definition of the lease, and then we booked it for the first time originally. What happens if we have a pre-existing operating lease that we need to convert under the ASC 842? So again, the effective date of the guidance for this is the lessee is January 1st, 2022, if you are assessing the practical expedience. Let's just say that the lessee entered into a 5-year lease of an asset on January 1st with an annual lease payments payable at the end of each year. The lessee is going to account for this as an operating lease, so it fits within the operating lease structure. It doesn't fit under one of the 5 classifications of financing lease. The lessee has deferred initial direct costs of $500 that are generally, under the old guidance, were amortized over the lease term. Unamortized of 400. So there's 400 of those left as of the date of implementation, which is that January 1st date. So you had things in the prior period under the prior leasing standard that we need to assess as well. Also with this, on January 1st, the lessee had an accrued deferred rent liability. So when we did the straight lines of all of our rents, you would create this deferral account. So we had that deferred rent liability of $1,200 that's sitting on the balance sheet. So we have $400 of unamortized direct costs, $1,200 of this accrued deferred rent liability. Where does that go now? How do we do the debits and credits and take care of this, right? So Brad's going to go over the debits and credits of an existing lease, and this should help you as you're converting over to ASC 842.
Thanks, Julie. I'm sorry, everyone, for my technical difficulties. So if you recall, under the old guidance, or more likely what you're still doing and ready to reverse effective the beginning of this year, we would make our cash payments with the credit to cash, and we would have a straight line rent expense that was recognized ratably each year. Your difference went to deferred rent. And then what were called indirect costs that were capitalized at the onset of the lease would be capitalized and amortized into a net rent expense. This kind of helps show the totals there, what happens between 2022 and 2025. And we will be sending these slides out, which I think would probably be most helpful when you're actually going through this to kind of get the mechanics down yourself. But to me, it was easier to see it broken out this way. We can see where our deferred rent that little 1 in the top line of the top table comes down effective 1/1/2022. As $1,200, that's getting reversed out and put into what I call this RRU asset base, or it will be merged with the RRU asset base, which is our day 1 equal to lease liability RRU asset amount. What you see in this RRU asset net column, that's what's actually hitting your RRU asset account at the end of the day. I broke it out just because people, they get confused, and I did too when I first saw it, how exactly our RRU asset would not equal our lease liability on day 1. So that's how it's hidden. You can see within that RRU asset reduction, our deferred rent is getting amortized down to 0. Our rollover, if you will, as well as those capitalized indirect costs. The interest component is, and I actually did this because we had a monthly payment example. I used the interest on a monthly basis multiplied by our liability each month to get that. And then that RRU asset base reduction is our straight line rent less interest, which is 6% times our liability. And then your lease liability will be similar and unchanged to the previous example, and is only our change in present value. And that's the kind of the gist of it. You can see that $129,200 is identical to the rent expense under ASC 840.
Perfect. Beautiful. So a couple of considerations we want to throw out, and just also to note that we will be getting back to you if you had some questions in our slides on these Q&A today that we haven't been able to get to. But again, easement considerations, this is just a couple of things that you should consider when you're thinking through easements, because in prior guidance, we really didn't take easements into consideration, but now we have to. And so specific considerations, cancelability of the easement, obviously if it's an upfront payment on it, that's not a lease because there needs to be a continuous payment stream. But can you even estimate the length of the lease? And I will tell you, we're struggling with this on this and hydroelectric. We've got some 100-year leases out there that what happens if the risk-free rate doesn't go out that far? How do you even think to consider what your rate of return would be on that? So things that we're continuing, we actually just peppered a question into FASB, so we'll let you know if we hear any response on that. But there are some considerations that are getting pretty substantial. And then I think we hit this pretty well in the front examples on the purchase power agreement. I mean, diving into the assets, are they identifiable? Is there significant substitution rights? Right to use, 90% rule of something. And one point I wanted to make sure that we meant that we say is if there's a variable payment stream, that's not classified as a lease. So if your purchase power agreement, even if it has another facility, but all you're doing is you're paying a rate per kilowatt hour, that is not considered a lease. That variable payment stream is not considered. However, if you have an identified asset and right to control, you're paying a variable and a fixed charge, that fixed charge may be considered a lease agreement. So again, something to consider as you're walking through this. Now we've got a bunch of questions that are in there that we will answer, but there is one that I wanted to take 1 minute to talk about, and that's poll attachments. We also wrote an article on poll attachments, leasing article that I can actually pop in the chat right now. That if you'd like to, if I can pop it in the chat right now, if I can figure out how to pop something in the Q&A. Where's the chat? Or hey, Pam, why don't you do that while we're getting done with this? So the poll attachment question is really it's consideration of whether or not what your unit of property is. If you determine that in the end of the day, the unit of property is the entire poll, then most likely they do not have right of control. However, if your unit of property is considered something smaller, maybe on a transmission tower where you actually built something differently because of this, there could be a consideration that a poll attachment gives right of control to that piece. So it is just important to understand the unit of count. We will also send this out to the people that ask that question just because I think it's a little bit more specific. Otherwise, we'll get back to you and the remaining Q&As. Danielle, turning it back to you.
Great, thank you. And thank you, Julie and Brad, for a great presentation today. I also want to thank the audience for being engaged and submitting your questions to help guide today's conversation. If we didn't have time to answer your questions, we will do our best to follow up with you after the webcast. Also, feel free to reach out to our presenters if you've had any additional questions. If you met all CPE requirements, your certificate is now available to download in the CPE progress window. A copy will be emailed within 2 weeks should you have any difficulty downloading it now. For those of you that would like a copy of today's slides, you can download them from the folder that says Slide Deck and Handouts. We will also be sending the slides via email tomorrow, along with a recording of the webcast. Finally, here's a link to an online survey for today's presentation. Thank you all for joining our webcast. We hope you'll join us again next time. Take care, everyone.